After several years of experiencing low borrowing costs, many real estate investors have been shocked by the increase in interest rates, which started in June 2022, but not all private lenders have increased their rates at the same pace. In this video, I'll explain why interest rates increased, why there's a big difference in rate increases among the private lending community, and how to find out the current interest rates charged by private lending companies, which are also known as hard money lenders or bridge lenders. I'm Rocky Butani, founder of PrivateLenderLink.com, where investors and brokers can easily find direct private lending companies. If you are in the investment real estate business and want to gain insights into private mortgage lending, subscribe to our channel and get notified every time we release a new video. The reason many private lenders increase their interest rates is because their cost of capital went up when the Federal Reserve started to increase the Fed funds rate in mid-2022 in an effort to fight inflation. Before explaining what I mean by cost of capital, I first have to explain the various business models used by private lenders as it relates to their capital structure for short-term loans. That will help you understand why some private lenders have lower rates than others, and why some lenders move their rates faster than others. The most popular business model in private lending today is for private lenders to fund a loan and then sell it to the institutional secondary market, which includes loan aggregators, private equity, hedge funds, and other investment firms. For simplicity's sake, I'll just refer to the secondary market as Wall Street. So the lender has the money on their balance sheet to fund the loan, but shortly after closing, they sell the loan to Wall Street, make a profit, and recoup their capital so they could fund more loans. The interest rate that lenders charge is based on the rate that Wall Street will buy at. Prior to mid-2022, Wall Street was buying short-term private mortgages for around 6 to 7%, and the lenders typically mark that up by 1 to 2%. When the Fed funds rate went up, it caused Wall Street to increase their buy rate, and lenders were forced to increase the interest rates charged to real estate investors due to the increase in their cost of capital. The second most popular capital structure in private lending is to manage a mortgage fund. The lender pools money from many individual credit investors, and they hold the loans for the entire term. The interest rate charged to real estate investors is distributed to the fund investors, minus a management fee or performance split. Most mortgage funds are not directly affected by the federal funds rate and are not forced to increase their interest rates. Fund managers will likely only take action when they see that most of their competitors have increased their rates and/or when their fund investors demand higher yields. Some fund managers won't make any changes to rates, and some have already had higher rates than the Wall Street-backed lenders. The next most popular capital structure in private lending is to use a bank credit line or warehouse line and hold the loans for the entire term. The lender borrows money from a bank or other institution and makes a spread on the interest rate that they charge to real estate investors. Lenders using this model won't be forced to increase their rates until the bank increases the rate on the credit line, which could take years since many credit line rates are locked for a period of time. However, there is a possibility of a credit line getting cut off. Another capital structure in private lending is table funding, where the lender does not use their own balance sheet to close the loans. They underwrite the loans and present it to a wealthy individual investor who wires the funds at closing and collects the interest payments. Lenders using this model may not increase their interest rates until their mortgage investors demand a higher yield. Now, some lenders get table funding from a private equity firm that relies on Wall Street money. In those cases, their rates may be moving according to the Fed funds rate. The fifth and final private lending capital structure I'll mention is similar to the Wall Street model, but the loan buyers are individual investors. The lender will use their own balance sheet to fund the loan, and shortly after closing, they sell the loan to an individual investor, make a profit, and then recapitalize so they can fund more loans. The rate movement with this structure is similar to mortgage funds and table funding. It likely won't change unless the individual investors demand a higher yield. And this may not happen until there are other alternative investments available to them, which offer a higher yield and a similar risk profile. By sharing all this information, I'm not suggesting that you ask lenders about their capital sources. The complicated part of all this is many private lending companies use multiple capital sources, financing structures, and business models. Some lenders sell their loans to Wall Street and also manage a mortgage fund. A lender could sell half of their loans to Wall Street and sell the other half to individual investors, while also managing a mortgage fund. Some lenders use all the capital structures I mentioned, and most lenders have a credit line. The point is just to understand why there is a disparity in the interest rates you see offered by various private lending firms. Now that said, the interest rate disparity in private lending has existed since 2015 or 2016, when Wall Street entered the space and provided the capital for lenders to fund the majority of real estate investors' deals throughout the country. The cheap capital caused by low interest rates enabled Wall Street to offer a lower cost of capital, which pushed private lending interest rates down, and the majority of the lenders with other capital structures were forced to lower their rates in order to compete. Since Wall Street capital is getting more expensive, it may provide other types of capital the opportunity to increase their rates and get a higher yield. If you want to keep up with private lending interest rates, use our website privatelenderlink.com as a resource. All the private lending companies listed have a detailed profile which shows their minimum and maximum interest rate. In some cases, the range is skewed by lenders that offer long-term rental loans, but most of the lenders listed only offer short-term financing up to 2 years. Contact each lender directly, and if you'd like some recommendations, click the Create a Loan Request button in the main menu. If you found the content in this video to be useful, please click the like button and be sure to check out our other videos about private mortgage lending. Thank you for watching, and see you in the next video.